My name's Dave Dubeau, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. You know what, you guys? I think over the last number of years, single family rentals have kind of gotten a bad rap. I mean, I've interviewed a ton of multifamily investors and syndicators and people in, industrial space and commercial space, and not very many people are in single family rentals at scale. But today's guest knows all about that. Noel Christopher is an avid skier from years gone by. He's zooming in from Colorado, where he gets to ski on a very regular basis. And he knows the whole life cycle of single family rentals. We're going to talk about that today. So Noel, welcome to the show.
Thanks for having me. I appreciate being here.
So Noel, let's zoom out and give everybody a big picture overview of what you do when it comes to single family rentals.
Yeah, so I've been in the single family rental space for quite a long time. I've worked for a lot of different companies spanning the entire life cycle of single family rentals. And currently I'm with a company called Fave Financial, also Genstone Companies, which is a brand of theirs. And we do everything from the institutional side of servicing loans. So we service 68,000 or so single family rental loans for investors, for medium and small size investors. And then all the services to then help those types of investors, from lending to title to insurance to property management to real estate brokerage to repairs and maintenance business to construction. Everything that has to do with single family rental is what we do. And my whole career, I've been involved in single family rentals for a long time. So this is really about enabling investors to effectively and efficiently own more homes, manage better, get better lending, get better, property services and financial services around the single family rental space.
All right. So I'm going to ask you a really, really, really stupid question, just because I really want to make sure I'm clear on this. But what is your definition of a single family rental?
Sure. So my definition of a single family rental, and really if you look at on lending, a single family rental is really anything under 5 units would be kind of considered single family rental, small multifamily. Okay. I really consider single family rental anything that's a single unit that is either a house, a fee simple house sitting on a lot that is a single home.
That's our little white picket fence. That's the idea, right? 3, 2, right?
Or a townhome.
Okay. Yeah.
Or a, maybe a 2 or 3 unit building could be considered single family rental in some sense. I really consider it townhomes, condos, kind of, but not really. Townhomes, single homes, garden homes, things like that are considered single family rental. And it depends on the market you're in, right? It depends on what's needed for that market, is what kind of house you have there. But yeah, that's what's considered single family rental.
Yeah, no, I'm just really curious what your definition of a single family rental is. That's okay. I wasn't completely out to lunch, but it is interesting, it's anything less than commercial, right? So could be up to 5 units, but typically it's like a single family rental, right? A house, a condo, a townhouse is probably more likely. Okay, got it. Now, because you've been in the industry so long, what do you consider the advantages to be up for single family rentals versus, everybody's so excited about multifamily, or at least they used to be. What do you think are the big advantages, or some of the advantages, to investing in single family rentals versus other asset classes?
It's a great question. We get this question all the time. I believe that you should have a diversified investment philosophy, by the way. So it's okay to invest in, I'm focused on single family rental, but I recommend investing into some commercial if it's the right time and the right asset class, investing in some multifamily. And single family is a little bit different than multifamily, a lot different, because you're dealing with a home typically, and people consider it more of a home than an apartment. A lot of people transition from apartments into single family rentals. A lot of people transition out of a home at an older age into a single family rental sometimes if they're tired of owning. And so the advantage is that you don't, and some people could look at this as disadvantage as well, is that you're scattered. So I would consider scattered site single family rental, not build to rent, which is more of like apartments. The advantage is that you have a single house with a single tenant or tenants living in that house, so that then you can have a diversification of your risk. You can have a diversification geography. You have tenants that typically stay longer, that are more treat it like a home. I mean, if you think about all single family rental houses, about 35% of them, I mean, all single family homes, about 35% of them are rentals. So you could take a development of single family homes that all get sold to homeowners over time. About 35% become rentals. And not everybody's destined or wants to own a home, but people want to live in a home. And so they have a different, as a landlord, the tenants take care of more of the house. They take a little bit more pride of ownership. As a tenant, you're living in a home. You have, your four walls that you're not sharing with anybody typically. Sometimes in a townhome, you share a wall, but still you have a yard and a garage, and your amenities is having that privilege of being able to live in a nice house in a neighborhood. I prefer scattered site typically because then you're amongst other homeowners. So you have more of that community feel, more of that neighborhood feel. And, you get a little bit more pride of ownership when if you're a rental on a house in a block with a lot of homeowners, you're going to take care of the house a little bit better because people have a little bit more pride of ownership. And so there's a lot of different things there. But having diversified assets and not having to, you can slowly buy up 1, 2, 3, 4, 5 single family homes over time. And usually you want to get to 10, 13, 14 homes, and then you're really diversifying your risk. So if one tenant isn't paying, you have all the other tenants paying. And so you don't have to go all in on a 13 unit building. You can build it up over time, and you have an asset that also rises with the home market. And there's a lot of talk about the home market in the US going down and all these types of things, but typically it goes pretty steady. So as the values of the homes go up in the neighborhood, so does the value of your rental, and you're not just reliant on the income of that house to derive your value. We're also reliant on the comp sales in that neighborhood. So a lot of people consider it a hedge that now you have a home that you could vacate a tenant, fix it up, and sell it on the open market. And the open market's gone up. You're seeing the institutional funds doing that right now. They're selling a lot of homes that the market's gone up in areas maybe a little harder to own a rental, and you're able to really massage your investments a lot easier.
Got it. Okay, no, that makes sense. So, Noel, you've been in this industry for a long time. You're working with a huge company that does a billion different things, it looks like. What's your particular specialty and your particular focus these days?
So I'd say my specialty, my focus right now is creating the tools for a lot of the investors that we service loans for. So we service about 68,000 or so single family rental loans that are small investors, medium-sized investors who've gotten a loan.
So loans, you mean mortgages, or you mean home equity lines of
Mortgages.
credit?
So like a DSCR or a business purpose loan. And they then now need services for that. So we're creating a marketplace. We're creating, we have property management, and we have construction services and repairs and maintenance services and all these different things to help them enable them to be more efficient. And so we're kind of taking we're taking an institutional view and helping this small and medium-sized investor to be able to own more, manage more efficiently. I mean, it's here in the US, there's no debate that some cities are making it harder to own rentals. They're aiming sometimes at the larger landlords, and that those regulations affect the smaller landlords. And so having a group that is able to look at their portfolio and say, hey, maybe you should sell this home. Here's how you can recapitalize. Here's some advisory services we could do for them to help them maximize their NOI and also buy more, buy less, sell some, invest other ways. In the past few years, when debt was so cheap, people didn't really see the money they were leaving on the table. And now that things have changed in taxes and insurance and the costs of debt and repairs and maintenance, all these things have gone up. Now you start to see the dollars and cents you were leaving on the table before that make a huge difference.
So how will you guys be able to service so many different landlords, owners, investors in so many different markets with things like property management? Are you outsourcing that? Are you partnering up with people locally? How do you even do that?
Sure. So property management specifically is very market specific. While we will partner with partners in markets that we're not in, we're really focused on the core markets that we know that we could scale our property management and offer an effective service. But the fact is that what's really key to property management is being able to have the density in a market to service the portfolio, for example, on the repairs and maintenance and construction and things like that. And that we have much of a national feel, but we're not trying to, unlike some property managers that I've worked for in the past, that it was about scaling at all costs and getting up to this high number of properties under management. We're really focusing on core markets, rolling that out along with our real estate brokerage in order to sell some of our other services like lending and title and insurance, real estate brokerage, different things like that, so that we can kind of go wide and not as deep. Because again, it's scaling at all costs in property management. It's really about density within a market. You could be in 50 markets and have 50,000 doors, but you still don't have scale within a single market. And it's important for us to have, on the property management side, have that scale. We're looking at creating tools for self-management tools, for example, so that investors can self-manage. We're offering, a lot of our services that we point towards our loan portfolio to investors in whatever market they might be in, because we have to service our loan portfolio in all markets. So
the primary business right now is lending, correct? That's the bread and butter.
Yeah, the bread and butter, starting with Faye, was lending and servicing, but over time, we've built these mature businesses around. I should probably say the newest business is property management, but around lending and title and insurance, and then construction, maintenance, inspections, things like that. Those have been all very mature businesses, and now they're being combined into one brand called Genstone, and we're offering that more as a third-party service. Although we do a lot of business with institutional investors and things like that, but really, it's the biggest pain points in owning an investment property is typically the repairs and maintenance. And I'd like to list a whole bunch of other things, but there isn't really a whole lot. Obviously, not picking the right location, the right property to buy, not vetting your tenant properly. But you could have the best tenant and the best property and the best location, but if you're failing on the repairs and maintenance, that's going to affect you going forward greatly, especially on retention, on rent increases, on the quality of how well your tenant takes care of the place themselves. Because if you're not taking care of it, they're not going to take care of it. So a lot of our business is on the property services side. It's derived around the repairs and maintenance business and making sure we have a robust repairs and maintenance business nationally. And if we have an investor come to us in a market that we're not in, that has a little bit of scale, we can go into that market very easily and then go to the rest of our investor base and pick up more property management doors that way. So we've rolled out 4 or 5 markets. Now we're going to go in selectively in markets as there's a need. Our plan is to be in, 30 or so markets by the end of 2026. And again, making sure we already have the density and the services there first so that we can properly service, whether it's 1 door, 50 doors, 100 doors, or 1,000 doors.
So really, do you guys only focus on single family rentals, or do you also do multifamily?
So by default, we do a decent amount of multifamily, because on the loan servicing, not only do we service loans that we originate, so we originate a decent amount of loans. There are a couple of our companies, Constructive Capital and FMS Investor Financing. We also service for other servicers. So our company, the servicing side is a special servicer. So we service FHA loans. We service any kind of interesting defaulted type of loans, any business purpose loans that span from small commercial to multifamily to single family, all kinds of different things. So we end up we're taking a decent amount of multifamily on. Our focus isn't on large multifamily; it's smaller multifamily. But on the default side, we do take a lot of different interesting assets, because we've seen a lot of these private lenders lent a lot of money to a lot of people doing a lot of different things in the past years, and we're seeing a lot of that come back with some issues. And the same thing when we see any of our borrowers that we service for, when they start going into, way before they get into default, we're engaging with them and looking at saying, okay, let's take a look at your portfolio. What can we do to help you not get to the point of default? And that's where it drives business into the property management and the real estate brokerage and the property services, so we can help them get things back up and going. Because we haven't seen a lot of default, but we see a lot of people who are having some issues right now, trying to figure out what they're going to do.
So it almost sounds, and forgive me if I'm not getting this right, but it also almost sounds to me like you guys are striving to be kind of like a one-stop shop for the smaller investor who's in primarily single family homes, but also smaller multifamilies. When everything's going full steam ahead, like they can use your brokerage service to buy and sell their properties. They can get the lending from you guys. They can get the insurance from you guys, the property management from you guys, the maintenance repairs from you guys. So it doesn't really matter where they're located. They can kind of plug into you, and all of that stuff theoretically should get and take
certain parts of our business. Property management, we're not everywhere, and we don't intend to be everywhere, but we do have partners in other markets, and it's small to mid-sized to institutional level investors. I mean, because we have a lot of REO from our loan servicing book, and we have a lot of asset, a lot of other non-generated lending servicing that we're doing. We get a lot of larger and mid-sized investors who come to us that are looking to deploy capital because we have the insight into the top of the funnel of investors knowing what they're doing. And this, what I call SFR 4.0, is there's a lot of money that's being amassed right now to deploy into the SFR space. The problem is that people are trying to figure out where they're going to get inventory. And so a lot of people come to us. We don't necessarily want to work with some of the larger institutional investors on acquisitions, only because we want to keep that book of business within us. So we'd rather enable our investors to be able to buy and sell from each other so that we can keep the business. Although we do work with institutional investors on different levels, whether we're servicing their portfolio, whether we're doing smart home rollouts for them, we have the scale to be able to do a lot of different things. But ultimately, we want to build our own ecosystem of investors and enable them to buy and sell from each other and grow.
Interesting stuff. Noel, if people want to connect with you and find out more, where should they go?
Best place is to go to LinkedIn. If you search me on LinkedIn, Noel Christopher, there's not too many Noel Christophers on there. And if you'll be able to see me very quickly. And I'm pretty active on LinkedIn. I do a lot of videos. And that's the best way. If you send me a message, I'll reply to you. Sometimes I don't have the answers that you need and I can't help you, but I love to talk about this space and we really want to enable more of these small and mid-sized investors to be able to invest more.
Awesome. Noel, thanks for being on the show.
You're welcome. Thank you.
All right, everybody. See you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewsyou.com.